A lot of private capital is sitting on the sidelines. Neither administration has yet successfully removed the toxic assets from bank balance sheets. Given that, how do you expect these stress test banks to recapitalize? How much do you think is a fair ratio between private capital and government sources?
Well, our approach will be to ask the banks to go first to private sources. And as I said before, I think that many of them will be able either to raise new equity capital, to convert existing forms of capital into common equity, or to sell assets or take other measures that will allow them to recapitalize themselves without any or without substantial Treasury capital. So that will be our first priority, and it remains to be seen how receptive the markets will be and what they'll be able to accomplish. But I do think that there will be significant opportunities for capital raising outside of the government's programs.
Do you think it will be a majority from private sources?
I think it will be significant. It's hard for me really to say at this point because it depends on the market's reception of what the banks propose to do.
Removing those toxic assets, real key to the economy. New proposal, public-private investment program. Last week, the Special Inspector General for Tarp in those programs identified a number of vulnerabilities and recommended both transparency, as you do, in the current bailout dollars, but also putting in place ahead of time some basic safeguards to deal with collusion, conflict of interest, money laundering, just basic, again, to build consumer confidence and also investor confidence in those. Are you aware of the Inspector General's recommendations, and do you support them?
Yes, I am quite aware, and I think they're very constructive. The place that they're most relevant to the Federal Reserve is in the TALF program that I mentioned, because it uses TARP capital. And the Special Inspector General for TARP had a number of suggestions, and we have worked with his office. We believe that that program, nothing is perfect. There's always a possibility of some problem. But we believe that we have taken substantial steps both to protect the taxpayer from credit loss and to protect the system from any kind of abuse or illegal activity. We'll continue to work with the Special Inspector General and make sure that we are, in all of our programs, protecting the taxpayer.
Treasury has not yet adopted, those recommendations. Would you urge them to move quickly on that?
I would leave it to them to discuss what their concerns are. I don't really know what the issues are that they're raising, but obviously we're all interested in making sure that the appropriate safeguards are in place.
With the cost of the deficits running unprecedented high in this country, there's some concern about what additional costs would come about because of the whole financial rescue efforts. Last week, International Monetary Fund estimates that those costs to U.S. taxpayers over the next 5 years will be $1.9 trillion. Do you see that estimate as too high or too low?
I don't know what that includes. If it means to include financial...
It included all from the Fed actions to the loan guarantees to the non-standard capitalization.
So from the Fed, we don't expect to lose any money. From the Treasury, there's some risk in their investments, but those numbers are, I have no idea what they refer to.
Okay. What is, as we move forward, what do you see as the Federal Reserve's exit strategy to wind down its emergency credit facilities and reduce the excess bank reserves to prevent higher inflation?
Congressman, we have spent a lot of time on this. I just want to assure you that we made all our meetings into two-day meetings, and we spend the whole first day reviewing our balance sheet, our programs, and thinking very heavily and extensively about exit strategy. We have a plan in place. We are trying to strengthen and improve it. Some of the components are, first, that many of the short-term programs will either wind down naturally or can be wound down. That's about up to $1 trillion of balance sheet that can be wound down through that process. Secondly, very importantly, Congress gave us last year the ability to pay interest on reserves. By paying interest on excess reserves, banks will hold their reserves with the Fed. That will allow us to raise interest rates even if excess reserves remain very substantial in the system. So that tool itself will be a very powerful tool. Third, we're looking at what's called reverse repurchase agreements, which essentially would allow us to finance on a short-term basis some of our asset holdings with non-bank investors, securities dealers or others. That would drain excess reserves from the system and also have the same effect. Fourth, Treasury deposits at the Fed drain reserves from the excess reserves from the system, as they have done last year, for example. And finally, if necessary, we can always sell some of our assets into the market. So we have a number of options. The exact timing and sequencing remains to be seen. We're looking at that. We hope to release more information about that. But we do believe that we have all the tools that we need to exit, to help this economy get back to a sustainable growth path, but also to ensure that we come out of this with price stability.
All right. Thank you, Chairman.